No quiet lead up to Christmas as central banks and inflation fill the diary. Wall Street's traditional Santa rally is missing in action as the final full trading week of the year draws to a close. Instead of festive cheer, markets are bracing for another blockbuster session. Rate decisions from the Bank of England and the ECB may struggle to steal the spotlight, with US inflation also in play. Will markets get any Christmas cheer at all? Jane Foley is head of FX strategy at Rabobank. So overnight, Jane, the dollar brushed off comments from President Trump that the next Fed chair will lower rates by a lot. Is the market's bet on an aggressively dovish Fed done?
Well, of course, it is going to be a topic that's going to come in and out of the attention, I think, as we move up to the spring and when Powell's term officially does end as chair. But the market is now of the view, perhaps, that the Fed chair, after all, is just one vote in the committee. And the committee, as we know, in the US is quite split on the view. And that is because, well, some of them, such as Waller, are very much of the view that the labour market is loosening and therefore we need more aggressive interest rate cuts from the Fed. Other members, quite not so. So, for instance, Bostic recently indicated that he would rather have steady policy through next year because he's still viewing inflation as the primary focus for the Fed. So a split committee, and that, of course, is keeping market concerns about Fed credibility at bay.
Well, November's CPI report due up today offers only a partial picture of inflation with limited monthly detail due to the shutdown. Is this a print that markets and the Fed will ignore?
I don't think it will be ignored. I think the market is focusing on every single piece of data that we get from the US. But of course, if the market does judge this to perhaps be not complete, then it will get less of, or it will have less of a focus or less of an impact on the market. But it will be one to watch. Now, the market as it stands is not expecting the Fed to cut rates consecutively. That, of course, because the committee is split. And I think this print is very unlikely to change that position. So an interesting piece of data, yes, but perhaps something that's not going to change the market's view on Fed positioning all that much.
Let's turn to across the Atlantic now. Markets are almost fully pricing in a cut from the Bank of England today. With sterling positioning already at its most bearish in 5 years, is the path of least resistance still lower?
Well, we've got to bear in mind now that there is only the minority of G10 central banks that are expected to carry on cutting interest rates into 2026, the Federal Reserve, the Bank of England and the Norges Bank. And of course, that does put sterling potentially on the back foot, the dollar potentially on the back foot as a result of that. But of course, what we can also have is some pushing back from those other central banks that the market is expecting to hike rates in 2026 and instead get the rhetoric from them indicating that the market is perhaps too optimistic on the potential for interest rate hikes. So there is some positioning adjustment likely to come through in the next few weeks, the next few months. But it does seem that sterling is likely to be on the back foot given the potential for perhaps more aggressive interest rate cuts given the softer than expected inflationary backdrop in the UK.
The ECB up next now, and after last week's hawkish turn, investors are watching closely to see whether the ECB backs it up with its forecasts and language. What are you expecting today?
Well, it is our view, it's been our view for a while at Rabobank that the ECB has completed its interest rate cutting cycle. Now, of course, that does imply that the next move will be a hike. And we have penciled in hikes, but not for 2026, but for 2027 too, in the first part of that year. And that means really, I think what we will see from the ECB today is perhaps some pushing back on the interest rate hike speculation. We expect them to underscore that they feel relatively comfortable with policy right now. And it's our view that they won't do anything in terms of moving rates during the course of the next year.
Finally, Jane, the Bank of Japan is widely expected to hike on Friday to their highest level in 3 decades, a major milestone. For yen watchers, will the guidance and tone matter more?
I think it is the guidance and tone. What's been quite remarkable, really, is the flipping in market expectations regarding this hike. When we did get the elections in Japan for the new leader of the LDP, and when Taichi was appointed Prime Minister, the market was of the view that she would lean on the Bank of Japan not to hike interest rates. That seems to have eased back now. The market fully anticipating a hike. But what's going to be interesting is the pace of the hikes through next year. So, for instance, we had a better Tankan report from the Bank of Japan this week, some interesting PMI data too, and some comments from the governor of the Bank of Japan that right now the economy in Japan appears to be doing really well, holding up against the tariffs from the US. And that is also a positive contributing factor to the outlook for Bank of Japan policy. But what we don't know is whether or not there is going to be any change in the pace if other central banks in the G10 start hiking interest rates too.
That was Jane Foley from Rabobank. Don't forget, you can watch more videos on Reuters.com.